For more on that, we turn now to expert appraiser Jonathan Miller, president of Miller Samuel. Welcome, Jonathan. Always great to have you. 4% doesn't sound so bad relative to other parts of the country.
No.
But it is more interesting to observe rents actually rising because, I don't know, a year ago, 2 years ago, I was reading stories about people negotiating their rents down. So explain the latest trend.
There's been a big about face in the direction of rentals, and the reason primarily is because of mortgage lending on the purchase side, meaning that lenders are very difficult with lending, issuing mortgages, and people that may have qualified a few years ago don't qualify today. Also, too, there's a lot of geoeconomic turmoil throughout the globe, and I think people are nervous and maybe taking a little bit longer to make a purchase decision. As a result, the rental market has really benefited.
So where are we seeing all the demand? I mean, break down a little bit. You know, it's always sort of in the fine print that you figure out that maybe there's an area that's skewing the data, or that there's a particular demographic that's skewing the data.
Yeah, in this case, in the rental market, we're really, while there's certainly a lot of strength at the upper end of the market, which is sort of a typical scenario, it really is across the board, and I think this speaks to this idea of credit and the problem on the purchase side. Just one thing to point out on the sales side, even though sales are off 4%, that's because a year ago we were coming out of the tax credit offered by the federal government, which artificially stimulated sales activity. So I would rather characterize the sales market in Manhattan right now as stable or flat.
So I'm just looking here. New leases are up over 50%.
Yes.
Those are new leases, meaning not people that are extending or renewing. These are new people moving into buildings for the first time, writing a lease with that particular landlord.
Yes, and a big reason for that increase is because you had the use of concessions by landlords virtually evaporate. About 60% of all rentals a year ago had some sort of rental concession, like a month or 2 or 3 free rent, paying the brokerage commission. Today, it's 3 to 4% have some sort of concession. So the use of them has shrunk, and when people are coming up for renewal and realizing they're not going to get free rent, they're testing the waters and looking at other places.
Well, look, Manhattan developers, landlords, very, very savvy and very quick to react to market trends.
Correct.
Do you think that we'll start to see more buildings that perhaps were built to sell convert into rental properties? Will we see more supply to meet the demand? And will the 7% price trend continue for rents?
Well, I think the 7% trend is purely dependent on how tight credit goes, and credit is not expected to ease in the immediate future. So therefore, I would expect, and we also have a long way to go in terms of we're 24% below peak rental rates adjusted for inflation back in '06. So it's not like we haven't been in this territory before.
We're not in pre-recession levels, but one of the few things that are actually rising. All right, thank you so much, Jonathan. Always a pleasure to have you on this show. That was Jonathan Miller, CEO of Miller Samuel, with an interesting look at one part of the real estate market that's doing well.